morning. Delighted to welcome no stranger to this stage either, Mr. Yahya Alyahya, who is Chief Executive Officer of Gulf International Bank, of course, hereinafter GIB. We're going to talk a little bit about the bank and its plans and its change in strategy, and of course, more generally about the financial services industry in Saudi Arabia and beyond. So let's start a little bit on the retail banking side, because the bank has, it's fair to say, made a strategic shift in recent years into retail banking, not abandoning its traditional commercial banking, investment banking, market-related activities, but augmenting that with more retail banking. Minister Al-Assaf, in his opening remarks, said, I'm not here to tell you that a year from now the rules will be in place for a surging financial services industry. I'm here to tell you that they're already in place. We've done it early. Is that how it feels from your side of the fence? And tell us a little bit more generally about your strategy in the retail banking sector.
Sure. Thank you, Christopher, and thank you for your money for inviting me again. I'm always delighted to be here. But really at the outset, let me just commend the participation of the CMA in the deliberations and sponsorship of this conference after a long absence from participation. To tell you the truth, I am extremely delighted of that, and I must commend the new chairman of the CMA for his very astute attention to the needs in the Saudi financial markets. He really has been playing music to our ears with his emphasis on the debt capital markets. So I would like to congratulate you on being able to have the CMA participate.
We're delighted to have him here, and we'll come on to wholesale bond markets and how that plays, of course, back into things like mortgages.
Sure.
In a moment or two. But if you could just sketch where we are.
I will get to your question. The first part of your question is about GIB. GIB has really enjoyed a number of competitive advantages in the past. It has an excellent footprint in the GCC. It has had maintained top relationship with top-tier clients across the GCC for 20 to 30 years. That is really a competitive advantage no indigenous bank does have. Secondly, GIB has a fantastic global outreach that it has enjoyed for a long time. It's been in the league with the top players globally. Third, it has developed niche areas in areas like project finance, structured finance, capital markets engagement, asset management. However, the biggest weakness that GIB had was the funding side. It always had a problem raising funds. Pre-crisis, we have witnessed a long period of about 10 to 15 years of easy money, cheap money. It's been taken for granted that it's going to be forever. And consequently, many wholesale banks found it easy to venture into long-term funding, etc., taking the funding from the market for granted. The recent financial crisis came to remind not just GIB, but also all wholesale institutions across the globe that funding is an issue. Back to Banking 101, the mismatch of the assets and liabilities is an issue. And again, if you go back to Banking 101, the most stable and affordable funding base is really the retail. And consequently, in the wisdom with the wisdom of the board and management and the shareholders, it was decided that if GIB is to capitalize on all of those comparative advantages that it had and had built over the years, and to sustain being innovative and an important player in the markets, especially in the GCC, it has to have a foot in the retail in order to have this stable and affordable funding base.
So you approach the retail banking strategy very much from the point of view of the liability side of your balance sheet.
Correct.
What type of products are you offering or expecting to offer in future in order to attract those deposits?
Well,
edging you towards housing finance.
Sure. No. I have no problem. You know, everybody around here, you know, knows what needs to be done. I mean, we're not really, we're not reinventing the wheel. However, the motivation for getting into the retail is from the liability side. However, once we are in it, then the asset side is also lucrative as well. You know, we've reviewed what banks have done here in the region, in particular in Saudi Arabia, especially new entrants, and we've reviewed the trends globally and where is retail banking headed. And we decided that we will be very focused. We will be offering a limited number of products, basic products, simple products, and we would be offering it to a particular niche of the clientele base, what we call the technophiles. So we will be targeting a segment of the market that is tech savvy. We will build our retail leveraging the technology. We are now building a state-of-the-art technology IT platform. We have engaged in the social media to try to understand the technophiles' needs and requirements.
That's because the channels through which you want your customers to transact business are online. You want that to be their principal mode of interacting with you?
Correct. They are no longer an alternate channel of service for us. They are the channel of service.
So if I have an account, I can't go and see my bank manager, Mr. Smith, sitting in the branch?
You don't need to. You don't need to. We are developing the technology, even at the level of KYC, that would enable you to remotely do all your transactions and meet all your needs, retail needs.
So how big is that market segment in Saudi Arabia, according to your marketing investigations?
It's a larger market. No bank has really capitalized on this segment particularly. Most of the banks, whether in Saudi Arabia or abroad, are offering it as an alternate channel, as offering it as by the way, we have an internet service, we have a telephone service, but that's why, because of the legacy of the brick-and-mortar models that are adopted by many of the banks, those were heavy investments that are made, and they would continue to cater to the customers that require the branch service. In our model, we are not interested in that segment of the market. We will leave it for the present participants in the market to enjoy.
So you want Mr. Banks with his iPad?
Correct.
So do we all.
And I'm capitalizing on the youth. I'm capitalizing on the people who have the gadgets in their hands, who are so advanced in using them, even beyond, you know, I see it with my kids. They challenge me. They beat me at...
Do you tweet yourself, Yahya?
I do occasionally.
Do you play Angry Birds?
Sorry?
Do you play Angry Birds?
I don't, but I watch my kids do that.
Well, I have an Angry Bird at home, but so you talk about the deposit side being an important and high quality source of funding for the bank. Notwithstanding that, as you've already mentioned, the CMA and Mohammed Al-Sheikh are very much pushing the idea of increased bond market activity, and that, of course, in turn would underpin a more active mortgage market, which plays back into the retail banking side. So what do you see happening now in terms of new areas of capital markets funding, particularly Sukuk, for example. You yourselves have done a Sukuk. You underwrote a Sukuk for Bahrain, so you're on both sides of that capital equation. How do you see that developing? And then perhaps we can talk a little bit about when you were roadshowing your own deal, what
Sure.
sort of questions investors asked.
Sure. Just a quick comment about GIB Sukuks. When I mentioned the financial crisis put the bank in a very awkward position where there is a huge mismatch between assets and liabilities, it was also inevitable for the bank to go out and raise long-term funding. And we went through a fantastic experience both domestically and internationally, and it's a fantastic story. However, back to your question on the debt capital market, I have been an advocate over many years of the need to really develop this market. And this is why I was pleased with Mr. Al-Sheikh emphasizing this area as an area for future development. You see, post-financial crisis, or even if we look before the financial crisis, because of the abundance of capital, like I said, banks found themselves tempted to provide long-term funding, and especially for project finance, for infrastructure. However, after the financial crisis, with the new regulatory regimes that are coming out of Basel and elsewhere, banks are going to be extremely constrained to offer the long-term funding that is needed. As a result, the only way this gap can be filled is through the debt capital market. Today, since the financial crisis until today, we've seen the government expanding their lending programs through institutions like PIF, like SIDF, and others. But that is going to be a very temporary fix. Unless you have a functioning debt capital market, you are not going to be able to fund the long-term projects that are anticipated, whether by companies like SABIC or SEC, or developmental projects like the railroads and the new industrial developments like in Ma'aden and others. And consequently, it's paramount to really facilitate the development of this market. Unfortunately, and to make a reference to what Dr. Al-Assaf said this morning, many regulations may be in place. There is a gap in the debt capital markets, but I think it's not really only the laws. You really need the infrastructure. The debt capital market requires an infrastructure that needs to be put in place. It's not helping that the government is extinguishing its debt. You really need government debt in the market to create the yield curve.
You need benchmarks,
for benchmarking on the pricing. It's quite welcome. Recently, the government is guaranteeing the issue of sukuk for GACA, for example, to fund the King Abdulaziz Airport with a government guarantee. That will help in bringing in the yield curve that will be needed. I hope the government would expand in offering the guarantees for such projects. Now, rating service is very important. SABIC and SEC and others who are huge companies can go and tap into the international markets to get ratings. But the the smaller in size may not be able to. And consequently, you need some rating service. Look, Christopher, in the past, banks leveraged their ability to assess credit risk in order to be able to evaluate projects and extend long-term funding. Now, if you are issuing sukuk or bonds, you are going to the investors, the institutional investors. Institutional investors do not have the capability to assess credit risk. They understand market risk, they understand sovereign risk, they understand many aspects of risk, but they don't have the capability to assess the credit risk.
Hence
it's really the banks who have that capacity. Now they cannot leverage it, so you need a rating service that assesses your credit risk.
Although in a sense too, there's perhaps something else playing into that, which is the well-publicized problems over so-called name lending, which we talked about here 2 or 3 years ago. So at the same time as the regulatory pressures, capital adequacy pressures on banks, the desire for greater market activity, market discipline and the transparency it brings and the need for ratings also perhaps help to move those second-tier corporates into a better place in terms of corporate governance. And another thing, of course, that Mr. Al-Sheikh said this morning was that corporate governance was not world-class, outside the CMA itself. He made that point very clearly. Now, is market discipline, is one of the collateral benefits of the growth of capital markets a new kind of transparency, a new kind of good governance within corporate Saudi Arabia?
Of course, of course. The tapping of the debt capital market is going to enhance all of these. Will enhance the transparency, will enhance the governance, because if you're tapping into the institutional investors' funding through the capital markets, they're not fools. The investors are not fools. They want to see, they want to understand how credible, how well an entity is governed, how transparent it is. So all of that is going to really help enhance transparency, good governance, because the benefit is better access to the market, better financing, more affordable financing.
It's a virtuous cycle.
Absolutely.
So to come back, perhaps looking at first your own example of raising bonds, raising capital through the bond markets, is Saudi risk properly understood and managed effectively? Do the international markets ratings agencies among them, do they understand and price Saudi risk correctly?
When you talk of Saudi risk, you need to look at maybe 3 categories of Saudi entities. The sovereign risk is very well understood, albeit I agree with Dr. Al-Assaf that the present rating of the Saudi sovereign deserves to be upgraded. But that risk is very well understood by the rating agencies and by the investor base. And we have witnessed this in the market when both at the rating level and the perception with the investors, the fact that we associated with the Saudi sovereign risk. The second entity are government-related entities or large corporations like the SABICs of this world, the SECs of this world. Those are also understood in the context of the sovereign, and consequently that risk is well priced. And this is why we see SEC, for example, going out to the international markets, issuing sukuk for 30 years, unheard of, first time. And I must congratulate Ali and his colleagues for being able to achieve such a milestone. So for sovereign and for sovereign-related entities, that risk is well understood. You can hope for a little more, but I think it is well under. The trouble is all corporate entities which have no link with the government, specifically. And for those, you really need a rating service that is entrenched in the ground here in the market. People who are living in the market, breathing the atmosphere of the market, understanding the intricacies of the risks, and being able to provide the proper assessment.
So implicit in what you're saying is that at the moment, for that kind of second tier or non-government related entity, the risk is not properly understood.
Correct.
Right. So
simply because there aren't enough means to be able to assess the credit risk, the credit worthiness of those institutions. You know, unless you really have probably a domestic rating agency or a regional rating agency, and you know, there are examples around the world, you know, the impact of the Malaysian rating agency over the last 20 years since its establishment, and how it has contributed to bringing depth and width in the debt capital market in Malaysia, where many entities in Malaysia are able to tap the domestic market that, you know, at the same time they were not able to tap. Now they're moving into the international market, and that's thanks to the good work done by the Malaysian rating agency, RAM, and the other.
Is there such an agency sort of bubbling under somewhere out there? Do you expect to see the emergence?
Well, I was very hopeful. You know, there was a conference or a workshop conducted like maybe a month ago by Standard & Poor's, and it was co-sponsored by CMA, which was very refreshing, and what is it? There is a group in Dubai, the regional Gulf Bond Society or something of this sort, and I read in it that this is probably an initial attempt to try to shed some light on the need for a rating agency, and I sincerely hope that this can take off as quickly as possible.
Very good. If anybody out there is planning to launch such a service, please tell us, and you can come and talk to us about it a year from now. Yahya, we'd love to carry on a little more, but there's a clear call to arms. Thank you very much indeed for your help. Thank you for coming and taking part.
Thank you, Christopher.